the 10th week. I mean, things are coming along fast. Winter's slowly moving in. Today, mutual funds. So, big picture is that we've looked at some different, or you're probably aware of some different investment opportunities out there. But this chart is just shows the stock market, just the Dow Industrials. I mean, this is a broad range of the market, but starting back in the turn of the previous century, going on up through 2015 or whatever, and it kind of continues. But anyway, this type of growth is over the long term is what you're after. We know inflation's happening. We know there's a lot of other factors, and so you need something that's going to be able to keep up with that. And so, like it or not, people generally are pretty risk averse, but you're going to find, well, you're going to be involved in the stock market at some point. And, I say that because most of your employers, most of your pension plans, even your PFD, all of that stuff is involved in investing, and so you're going to have some exposure. The easiest way to do it, the typical way to do it, is through mutual funds. We've talked a little bit about individual stocks, and a lot of that is just to provide you sort of the background on what the underlying assets in a mutual fund are. Now, mutual funds can be comprised of bonds or stocks, so either equities or basically borrowed money or all sorts of other creative type things. I mean, you can get exposure to cryptocurrency, you can get exposure to all sorts of other assets, but I'd say 90% of the funds are made up of regular stocks. And the advantage of doing that is not only for the ease of transferring and the rest of that, but also it transfers the management and the buying and selling tasks, of the assets under management to a mutual fund advisor and to other companies. So institutions are very comfortable in dealing with these folks, and it's they're pretty slick in terms of marketing and web presence, and you can kind of go out and live your life, and if you're invested in the right funds, they can handle the more of the grunt work in terms of the analysis. You still have a responsibility to look at the fund's performance and all the rest of that, but the day-to-day buying and selling decisions in terms of the underlying assets, that's turned over typically to somebody else. So the portfolio manager is that person, somebody who's obviously got some skills. They are known in the financial industry. Those people are compensated well if they get great results, and not so much if they don't do well. The price of a share of it's not that big a deal to you, but obviously it's not tied to an individual asset because you've got a whole group of assets under that fund. So it's a net asset value, and typically they do it daily. Although, again, with the ease and the speed of computing power, it's not a great leap to do it intraday. Mutual funds, though, as opposed to stocks, too, they're more of a buy and hold type of asset. You don't necessarily speculate with mutual funds. You don't jump in and jump out. The underlying assets may vary, but that's on the portfolio manager. Trading actual mutual funds and speculation and strategizing like that, not typically done, and many times frowned upon by the companies themselves. Some of the funds will limit the number of times you can jump in and jump out. That's not what they want. They want that stability of the underlying capital they have to work with. They want some stability in that, and so they very much don't want you to do that. The problem with mutual funds, though, if there are problems, is they do kind of become the elephant in the room where, let's say they find a small company that they want to invest in at some aggressive fund strategy. Well, the fund is so large that small movements or even rumor that they're investing in a company can distort the price of some of those stocks. And so you'll see that sometimes some of the biggest mutual funds may not be able to get the best performance anymore because they don't have that freedom to jump in and buy things at a good price, because they drive the price just by being involved in it. Open end versus closed end. We're not going to spend a lot of time on this. It's a distinction without a difference for the most part. There's some different ways that mutual funds can be managed. You can have funds that are closed, like I said, that have gotten too big. You can have ones that are sold only by agents, which is kind of rare, not typically done. And then you've got some of these other ones where there's commissions and charges, and for the most part, they've gone the way of stocks, where there are no commissions charged, and the only people paying commissions are suckers. So load versus no load. Yeah, I've never bought a loaded mutual fund, and I don't think you should either. The problem when you're investing, if it's not just folks, the load is a commission paid to the agency selling it to you or the salesperson who organized it. It's not necessary. If you're in a retirement plan with your company, you're definitely in a no load fund. But if you're approached individually or something related to that, yeah, you may run into some sort of salesperson. They're quite prevalent in the military because they get out there and whatever. It's just kind of unprofessional behavior on my part, because they come up to you and they act like they know you, and they're usually some senior officer who's now retired who's pushing the stuff on the younger officers and the senior enlisted. Anyway, no need to pay loads, no need to pay a commission, because the problem again with these commissions is, since they're charged initially, the time value of money here just kills you, because let's say they take a few percent off the top. Well, that's money that you're putting in early in your career that could grow into a huge amount of money. So it's the dollar value of their commission is just phenomenal on your overall performance at the end. So here's a guy with a no load versus a load fund. And it affects, here the company's doing quite well, makes 10%. Here's another company doing quite well, but because of that commission, that load fee, his return is greatly reduced. Expense ratio, yeah, I would not go directly on expense ratios in terms of selecting funds. Like in sports, the coach that gets the results, he gets paid well. He gets compensated. He or she, obviously. So expense ratio, if somebody's out there killing it and getting great results, maybe they're going to get paid a little bit more. Now, if they're charging a huge fee and they're not getting the results, then I don't want anything to do with them. So there's more factors involved in this, but what you're going to look at is a couple companies, one of which is Morningstar, that's kind of a third-party evaluation that's going to it's going to rate these funds and make it comparisons for you. Yep. Fans with, depends. The part, we're in an era that I think has ended now, where the market was generally just going up and you could make money regardless of what you're investing in. And so there were a lot of very low expense ratio funds that just invested in companies, didn't do a whole lot of management, didn't do a whole lot of selling or analysis, and they still did well. And so just the fact that their expense ratios were lower, their performance was still comparable. And because of lower expense ratio, their overall performance actually in many cases exceeded that. I'm not sure that that's going to be the case anymore, but you have to look at the big picture. And if a fund has got a higher expense ratio, make sure it's worth it. Mutual funds, we could talk all day on this. The deal with mutual funds is they are a product that's marketed to people. So they'll call the mutual fund whatever it takes to sell it. So there'll be some broad categories, but the actual names will be specific to individual companies. In a broad range, though, we talked about growth before. Growth funds would be companies that are still growing, and so they're not typically going to be paying a dividend. They're not going to be an income stock. They're going to be a stock that's investing whatever profits they make back into the company to help it grow. So capital appreciation funds, how is that different than a growth fund? Again, they're just using subjective terms in here. Stocks that are expected to grow at a very high rate. Well, that sounds like anyway, very much related. And you're going to want to, typically when you're younger, be invested in these types of companies because you're making an income right now, but what you're really trying to do is you're trying to generate wealth. So extra taxable income right now may not be what you want. What you really want is the share appreciation over the long term. And again, growing companies and companies that are appreciating rapidly are more volatile. Well, if you've got 20, 30 years to retirement, then over the long term, you're going to be just fine. But in the short run, there may be up and down turns that might be a problem if you're actually retired and trying to live off that money. Small caps, mid caps, there is a dollar figure that equates to these numbers. Again, we're not going to concentrate too much on that, but just keep in mind, smaller capitalization firms, a small cap is going to be a bit more volatile because they don't have as much to work with. They haven't, don't really have a track record and they haven't gained that much in terms of funds just yet. Equity income funds. So this is a more mature fund. So they're kind of making the case that small, mid, and then they don't say large cap in here, but that's, this is a larger established company that now, rather than reinvesting, is paying income out to the shareholders to attract more shareholders. Balanced growth. So again, subjective terms. Sector funds. Sectors can be divided however you want. They can be geographical. They can be, in this and tech, medical. We'll look at some examples of some companies here to get a better eye on what that can be. Index fund. This is what I was talking about when I was talking about ones with low management fees, where they just buy into an index. I mean, obviously a monkey, but now even better, a computer can just pick a certain number of shares out of an index. So there's indexes that we've previously used to track the market. When somebody says, how's the market doing? Well, it depends. There's going to be certain, winners and losers throughout the day. So for tracking the overall market or segments of the market, they've come up with stock market indices. And so these indexes will be, the Dow Jones or the Standard & Poor's 500, whatever, a selection of companies. And if you're buying an index fund, well, they'll go to those, 500 companies out of the S&P 500, and they'll buy whatever number of shares per, for every one of those 500 companies represented, and they'll just hold them. And so obviously there's not a whole lot of work to be done. There's no buy-sell decisions. They bought and they hold, and that's it. So the fees are going to be exceedingly low. And if the market's going up, cool. I mean, you're making money and very low expense figures. So, um, international stock funds, um, very closely related to global funds, except an international stock fund means that it can invest anywhere, but in this case, the United States, because it wouldn't be, international if it's within the U.S. A global fund can invest anywhere to include the U.S. So, minor difference. Socially responsible stock funds. Okay, again, very subjective determination. Generally, companies that do things properly and act properly are rewarded in the market. The evil corporations that have bad behavior, that sort of catches up to them, especially if they have a presence in terms of retail markets and the rest of it. So I'd like to think that you would want to invest in socially responsible companies because they're going to probably make more money in the long run. Now, in terms of the mutual fund company putting them into a certain category, I don't know. It's tough enough to get good results out of a mutual fund, and when you start tying the fund manager's hands based upon some other criteria, kind of tough. But anyway, if you've got the time, you can definitely do the research and maybe find some companies that agree with your societal views. Enough said. Other stock funds, yep, they can be combined however they want. I mean, there are more mutual funds than there are companies that publicly sell shares. I mean, it's huge. The mutual fund companies, or this whole concept, really took off probably 30, 40 years ago, and it just gets bigger and bigger. And now, I'm not saying things are going the other way, but with ETFs, exchange traded funds, because the stock market used to be reserved for non-retail investors, just big professionals. Well, now with computers and programs and people's sometimes interest in the market, there are products that kind of form a link back to the stock exchanges directly. And these things can be traded throughout the day, and they do have some interesting properties. So it's nothing scary. It's just a mutual fund that's traded more like an individual stock, although they're funds. So don't get too wrapped up about it. I've got ETFs. In fact, there's a crypto ETF that I'm hope's gonna come out here, and it's gonna switch what I've got in a mutual fund into an ETF. And if that happens, ba-bing. Hopefully a lot of people make some money on that. We'll see. Okay, so other companies, I talk a bunch about Fidelity just because I'm used to Fidelity, but there's other companies out there, and here they're referencing Vanguard. Vanguard's fine as well. We're going to look at some of these companies. Bond mutual funds. These things can be, now if they're treasury bonds, obviously, for this bond not to pay, things have gone horribly wrong. The federal government has failed us, or the whatever municipalities have failed us, which, especially in terms of the federal government, when they can print money, they're not going to fail. And when municipalities are backed up by taxpayers, their likelihood of failing is quite low as well. So everything's risk versus reward. So a treasury bond fund is typically not going to pay a very high interest. Although right now we're getting about 5% in a lot of these cash fund type things. Ginnie Mae, this is tied back to real estate. Again, are people going to just en masse default on their homes? Not typically. So again, probably very secure. And then corporate bonds. These can, because they're tied to companies, which, in a perfect world wouldn't be bailed out by the government continuing. There would be some failure allowed. They are going to have a higher default risk compared to the government. But anyway, the quality of these underlying bonds determines the quality of the overall mutual fund. So again, you'd want to do look at a third party analysis to see how they rate those bonds. High yield, yeah, high yield and junk they're referring to the same item. The reason why it's paying high yield is because there's a greater default risk. So if they don't default, you're making good money. If they do default, you have junk. Municipal bonds, many times people invest in those, like I said, typically because of tax situations where they're in a high tax bracket, and they want to make sure any more income that comes in is somehow tax-free. Index mutual funds, so again, there are bond indices out there, and these would be just aligned like that, like a stock fund. So same thing with international. You could have global. You could do this whole thing. Once again, and maturity classification. Since bonds have a time element associated with them, you could have them segmented by their maturities, like they say. Return from a mutual funds. So just like a stock, if they've got income stocks under them, they're going to be paying a dividend. And then capital gains means when they buy and sell the underlying securities, those can be distributed back out. And then if you have the overall mutual fund and you sell that, you can get capital gains from that as well. So very similar to the way stocks would be oriented. Short term, long term. So typically, if you make short-term capital gains, they're added to your regular income, just as if you got them on a W-2 or something like that. And so they're going to be subject to your normal taxes, which are, in most cases, about twice what they are for long-term capital gains, which are typically down at 15%. So political situations can change tax rates, but anyway. Risk from investing in mutual fund. So what you're gaining by investing in a mutual fund is diversification. You aren't in a single stock. You aren't tied typically to a single company. But, if the overall industry or the stock market in general goes down, yeah, you're right there with them, and you'll go down with the overall mutual funds. So, conservative stock index fund. Yeah, limited risk, limited return. So, return and risk should be directly limited, directly related. Yep. So, that's how it works. It pays your money, takes your chances. Same thing about bonds. Must also consider default risk. Well, up here with these companies, they're invested in private companies. You must also consider, bankruptcy, corporate failure. So, here's how they're showing. This is just a general type thing. Index fund, a broad index. Yeah, the indices. Well, the indices are they can be, you can have an index of small cap funds. But if you're going with, the Dow Jones or the S&P, then it's going to be larger companies, so more established companies. So they're not going to be made of very small companies. Income, again, bigger companies since they're paying a dividend. Balance, now we're getting more growth in there. Here we're getting higher growth. Technology, very volatile. A lot of times using borrowed money, so interest rate sensitivity there. And then foreign growth, this is assuming that the United States is the most stable economy, which is probably a good assumption. But yeah, if you're focused on the economy of, say, Vietnam or something like that, I don't know that much about the economic stability. I do know from living in Turkey for many years, the inflation rates there. I mean, literally, they would come out about once a year and they'd issue new bills, and they would just take the zeros off of the bills. You were walking around with 500,000 lira notes there for a while, and now all of a sudden you're issued new 50,000 lira notes. Anyway, so when you start bringing in some of those currency fluctuations into the mix, it does get riskier. One more thing to consider. Same thing with bonds. Short-term bond funds, so they're only forecasting interest rates for a shorter time, so that's lower risk. You're not making a guess, years ahead like you would in a long-term fund. And then they're in a T-bond, a treasury bond, so it's a government bond. So short-term treasury bond, very low. Go out here to the other extreme. Now they're long-term, so they're making a forecast for a long ways out, and they're dealing with some, let's just say, flaky type companies, companies that are having to pay a high rate because that's the only way people will buy them. I mean, companies will only offer a bond rate they'll only offer you enough money and interest to get you to buy it. If they could get by for paying you, 3%, they would. But most advisors would look at the risk involved. They'd say, no, that's going to take 8% for us to get involved in that. You want the return commensurate with the risk exposure, and so that's what happens. Investing in a bond, so yep. Longer terms more sensitive. Default, yep. All types of risks. Potentially high return, so it can work out well if you get it. And again, chart that sort of mirrors what we're talking about. Selecting a mutual fund. The prospectus. The prospectus is kind of the rules of the road, and not to badmouth the environmentally sustainable goals, but yeah, the fund manager may be prohibited from investing in certain regions or investing in certain companies that have, whatever, something in their portfolio. Say there's some huge multinational, but, 1% of their thing, makes cigarettes or something like that may preclude you from investing in that company, and that may be a great thing. But anyway, all those rules are going to be spelled out in the prospectus. It's going to be sort of the game plan for how that company can be involved. And so you're going to see things where they may address some of the things we were talking about with short selling. They may be doing some hedge fund type maneuvers where they do some aggressive, buying and selling. And anyway, those will all be spelled out in the prospectus. And the fund manager is limited by that prospectus. If it says that they will invest, only in companies within the United States and only, that meet certain criteria, then they're limited to that. And so you need to read that prospectus to figure out what you're kind of getting involved in. Yep. Investment strategy, past performance. Interesting, but you're buying on future performance. So whatever conclusions you can draw from that. Fees and expenses, those will be spelled out. Certain amount of risk. I mean, they have to, it's a legal document, so if they say, oh, this is absolutely without risk, and then they lose a bunch of money and they're challenged in court, they'll, these folks have to stand behind their editorial comments, basically. And it'll tell how things are distributed. Also tell how much you have to invest, if there is a minimum, and how to buy and redeem shares, and the rest of that. So rather than look at their thing, we're going to, now they're talking about Fidelity, but we're going to look at a couple different indications here. So first off, Morningstar, a company, you don't necessarily have to, take a subscription with these folks, because a lot of times you can find their information available out there. If I was somehow a student and had a few $100,000 to invest, well, $25 is not a whole lot of money to get a trial. But again, you're going to find these mutual fund companies and companies like that interested in college students because they see you as their future customers, and they figure they can get you in on a trial membership, and then you'll just stick with it and be a customer for life. So those things are out there. Here's jumping into Fidelity just to look at some of their funds. So here's all the mutual funds. So they will allow you to buy from other companies. Here's 10,000 funds. So when somebody says, well, this is the best, 1 out of 10,000, kind of difficult. They'll try and direct you towards their funds, obviously. They know that, it's all marketing here, so, talk is cheap. They will try and at least go with Morningstar ratings to get you steered in the right direction. No transaction fees. Many funds, most funds, and you can search around. So, different ways that you can look for, mutual funds, what you want. Here under Fidelity themselves, you can see some of the categories that they would have. So domestic equity obviously is not international. So these are going to be companies based in the United States where you're owning a stock fund since it's an equity. Here's international. Sectors. So sectors can be divided however. They've already got the, geographical sectors here in the other section. So, yep. Energy, financials, materials. Again, these are just categories that they've chosen, so maybe tough to compare. Income, this is going to be, funds are going to be paying a dividend, or maybe here in bonds. Asset allocation. So these are ones that may be tied to a retirement strategy. So let's say you're going to retire in 2060, and so that's a target date. So you might look at this fund. We'll just go through and just kind of explore this. Okay, so 2060 is the target date that they think, this fund's going to be at its greatest point. Everything is going to be timed there. Everything's going to probably be in growth here until you start getting close to the end, in terms of getting closer to 2060, and then they may switch to more conservative type funds. How are they doing? Not bad. Almost 10%. Over 3 years, start factoring COVID, not so good, and then a little better since the inception. Morningstar category, inception date, some of the funds, expenses, what are they invested in? Well, we should be able to see some of their investments, and they're actually, I believe they've got more mutual funds under there. So let's dive into a company. Here's opportunistic insight. I mean, can you get more subjective in terms of just word salad there? So that mutual fund we looked at, the 2060, had other mutual funds that it owned underneath. So now we look at that actual mutual fund. So we've dug down a little bit. Opportunistic insights funds, right? what do they actually own? Well, let's look at their top 10 holdings. So, Facebook, 10% Facebook. Berkshire Hathaway, that's another basically mutual fund. Microsoft, Nvidia, good stock. Amazon. So these are just the percentages of their thing. Another thing that you should look at when you're looking at diversification with mutual funds is to look at how the funds are diversified. You may say, oh, I've got diversification. I own 5 different mutual funds. Well, if you look at their underlying assets, and I've done this before with my own stuff, and you find out, oh, everybody owns, Nvidia and Apple. And so do I really have diversification? No, I've got 5 different funds that generally have the same underlying assets. You can find that quite common. Anyway, so the Morningstar information, again, this is free. We're not signed in, and we're getting Morningstar information. If you're going to make a huge purchase into this thing, you might want to dig a little deeper, but they're going to put this information out there because they know, consumers are looking for it. So nothing special about Fidelity. Here's a Vanguard site that you're going to see some of the same type of things. In fact, let's look at this. Here's, sort of a mutual fund selector, and you can compare different funds. So here's that 2065 Freedom Fund class. I don't know if that's exactly the same. The other one was 2060, and here's a Vanguard fund. How do they compare? What's their expense ratios? So you could line this up if you're trying to make this decision. And again, they'll allow you to compare to the competition. Obviously, they want you to buy, but they'll give you the Vanguard one or Fidelity. I mean, not Fidelity, or other funds. So whatever company you want. And you can see these are mutual fund companies. I mean, rows upon rows. Small guys and some big ones. Looking for somebody these are just, it's immense. Oakmark. Huge. T. Rowe Price is a big boy in there. And you could go through all the T. Rowe Price funds and find the one. But obviously, comparing emerging markets to these other ones it would not be very useful. So anyway, comparison factors. Obviously, the Vanguard one looks to be doing a little bit better. 7 point. But we need more years. On the current stuff, almost equivalent. 11 and 11. But again, compare these rates to what we saw back in when we were on Chapter 4, when we were talking about bank rates, and we're talking a percent or two on your savings accounts, not even keeping up with inflation. These guys are outperforming inflation. So, anyway. Financial quotations. These are done the same way as stock quotes with the same chart. So this tabular data, not very useful. What you're really after is more chart data. And you can compare mutual funds just like you do with stocks. Mutual funds will have a ticker symbol, and you can use them on a chart just like that. So I'm not going to spend a lot of time on that. Mutual fund education. So this is the larger mutual fund organization, and another place where you could look for information. But as you saw, even if you go to an individual company, they will feature information on their competitors because they want you to be their customer. If you want to if they can steer you onto their website, Fidelity or Vanguard is perfectly happy to sell you the competitors' products through their own website, just to keep you a customer and not have you dangerously going to the competition site. If you want to buy a Fidelity mutual fund through the Vanguard site, Vanguard will enable that. So diversification amongst mutual funds. So again, make sure if you think you're gaining diversification, if that's your goal, by buying different mutual funds, make sure that to look at the underlying assets to ensure you actually have diversification. Yeah, economies tend to go up and down together. And with multinationals, with globalization, you don't necessarily find certain countries doing better than others. It tends to be kind of a one big family. And we talked about this. So if you want to invest in foreign stocks, you don't go to, the foreign exchange, or else you will set yourself up for a lot of work comes tax times, and you'll probably break a few laws. If you want to invest, if you want exposure in other countries, there are easy ways to do it through the mutual fund system or those companies that are traded on U.S. exchanges. Otherwise, you get eaten up by compliance and currency risks. So more aggressive, you always hear about hedge funds. Again, those tactics that are employed by hedge funds can also be employed by regular mutual funds. It's not necessarily a whole separate category. Bernie Madoff, guy who was out there several years ago. What happened here? I mean, there's scams that are always. I mean, Bankman-Fried is in the middle of something right now. If you're getting a huge return and you're, not enduring any risk at all, you're fooling yourself. What this was called, Ponzi schemes are out there. It's actually named after a guy named Ponzi, and Ponzi schemes, what Madoff was running and what other people have run and will run, are schemes where they get investors to, put in a bunch of money and then they start paying them back huge returns. And the returns that they're paying out aren't necessarily coming from investments. They're coming from newer investors. So, you invest $10,000 and all of a sudden you start getting $1,000 a month in returns, and you're like, this is great. Well, after a few years, you realize that $1,000 a month is coming from the new investor, and all of the underlying assets don't exist. And at a certain point, whatever the life of the scheme is, 3-5 years, whatever, it can get bigger. They just take the money and run and leave people hanging. So, bad deals. Homework. So, yep, just a couple stock trays. We've done that before. We've even done that on the test. But it's becoming a little bit more relevant. So, stock rates on this, the 7.9, I kind of did an example for you. All you do is just, you look at that tax rate of 0.28 if you wanted to do that, or 0.72 would be the amount of money you get to keep. If you're in a 28% tax bracket, that means that you get to keep 72% of the money you earn. So you multiply that 72% times 10.2, and is that number higher or lower than the tax exempt ranking? It's that easy. And then bonds, we know that bonds with interest rates can change. So the attractiveness of your bond in the secondary market is directly related to the prevailing rates. There's a podcast out there that it goes through a situation where you have an index fund versus a fund that's actively managed. So sort of a buy and hold scenario versus actively traded scenario. So it's getting to be a bit dated now. It's off of NPR, but it follows a couple people, the Vanguard guy and also Warren Buffett, and both of these guys have been successful, but just rich people. They made a bet over which would perform better, and it's interesting to listen to, and it kind of emphasizes, it explains a little bit more about index funds versus actively traded portfolios. So that's kind of good. And the term project. So you're getting to the point now where you've got pretty much enough information to move forward with this. And again, tailor it to your own needs. Hit the page limit. You need 4 to 5 pages. You need to put it together in some sort of narrative, but address these questions and you'll be fine. And again, go back to those same mutual fund websites is where I would start out with, the brokerage websites, and look at some of the information they offer you, and you should be able to put together a pretty good plan that will be useful to you in the future. And that's about it for today.